Good evening, students. I hope you have fulfilled your promise last time. What you had promised to me was that you would look into you would revise the poem part. Have you done that? Yes. Have you revised it? Mansha, if key management decisions are taken in India as well as outside India by board or senior managers, then how to determine the poem? In that particular case, Mansha, what you need to see is that if you are not able to decide if they are taken both in India as well as outside India, right? So then you need to see that which decisions are strategic or where the strategic decisions are being taken. And let's say you're not able to come to a finding that whether the decisions where these are being taken in India or outside India, both places the strategic decisions are being taken, then the location of the head office is also important, or the location where the company is carrying on the business activity, that is also important, as well as where the books of accounts are kept. That's what the CBDT guidance says. And finally, if you're not able to come to any conclusion, then the CBDT guideline says that if the poem is outside India as well as in India, then it will be deemed to be predominantly in India. So the CBDT guidelines are very, very clear when they say that in case one is not able to decide conclusively as to where the poem is, then in that particular case, it will be concluded that it is in India as well as, if it is concluded it is in India as well as outside India, then it will be considered, it will be deemed that the poem lies in India. So if one is not able to conclude that particular point, then in that particular case, the poem will be considered to be in India. That's what the guidelines are talking about. Are we clear, Mansha? So place where main and substantial activity, place where the accounting records are kept, these are also to be considered. And if you're still not able to arrive at any particular point, then in that particular case, the CBDT guidelines are very, very clear. They say that it will be considered to be in India. Yes. Yes, Kaushiki, good. Yes, Parshottam, you can ask the doubts. I would answer it at the very end of the class then. If it is pertaining to the lectures which are before the international tax. But yes, you can definitely ask it. Fine. Okay. Yes, let's proceed further then. Yes, very good, Geeta. You've revised. Good. Okay. Sure. Let's proceed then further. Now, the next part, what we are going to start with, having done section 6, okay, having done section 6 now, we will be moving towards section 9, because section 6 is about the residential status, and then we have section 9 of the income tax, which is talking about the deemed accrual. Section 5, we have already done it, scope of total income, right? That is already done. Now we move towards the section 9 of the Income Tax Act, which is the deemed accrual. Now what does section 9 says? Let's try and understand. So section 9, which is there, is talking about the deemed accrual. Section 9 talks about the deemed accrual concept. When is income said to be deemed to accrue or arise in India? Now this is very, very, very important section which is there, okay? So let's write down section 9, income deemed to accrue or arise in India. Income deemed to accrue or arise in India. Fine. Now, first we'll start with section 911. First, we'll start with section 911, but before that, I'll give you the snapshot of section 9 so that you know what different streams of income section 9 is covering. So, 911, which is there, . or this is 9.1 only. Okay, so first one which is there, the 9.11 which is there, talks about the income which is accruing or arising from or through the directly or indirectly through or from any business connection in India. So 9.11 talks about the business connection or let me just put it a second limb only. Let's do it like this. 9.11 talks about business connection, income from the property, from any asset, from any source of income, or from the transfer of a capital asset. Transfer of a capital asset situated in India. Okay, so that is my section 9.11. Section 9.12. Section 9.12 which is there. This is talking about the salaries. Income which fall under the head salaries. 9.13 is in respect of the salaries which are payable by government. So salaries of government employees. 9.14 talks about dividend. Dividend is covered under 9.14. 9.15 royalties. 9.15 is interest, 9.16 is royalties. Interest, and then 9.16 is royalties. And finally, 9.17 is fees for technical services, FES. Fine. And now there is one more 9.18. (9.18) is in respect of gift of any sum of money or receipt of sum of money. Fine. So this is the snapshot of the section 9. Okay. Purushottam, yes, I'll answer your question later on, which is in respect of GAR or capital gains. Okay, I'll answer it at the very end. So maybe you can get the answer either before the break, we will take up your question, or before the end of the class. Okay, as the time permits. Now, coming to the first important section, which is section 9.11. Section 9.11, first we are going to deal with it. Okay. So this is about the section 9.11 says, in case I show you the section 9.11 itself, it says all income accruing or arising, whether directly or indirectly, through or from any business connection in India, or through or from any property located in India, or through or from any asset or source of income in India, or through the transfer of a capital asset situated in India. Okay, so this is section 911. So what are the points which are covered over here? The business connection, then property, asset, source of income, or capital asset, transfer of a capital asset situated in India. Now first we'll talk about the business connection. The first one, we are going to touch upon the business connection. Fine. Now, with regard to the business connection which is there, what is the meaning of the business connection? Is business connection defined under the Act? The answer to that is no. Business connection is not a defined concept. It's an inclusive meaning is provided to it. It's not defined. Watch the explanation to section 911 provides it that business connection will include certain activity or certain person. But the business connection is not a defined concept. It means that, so the courts have interpreted this particular term as that when, let's say, for example, a non-resident is carrying on the business in the other country, it should have a substantial linkage with that country. An isolated transaction will not result in a business connection. Business connection denotes some kind of regular activity, a systematic activity being carried out in the other country. So courts have interpreted this particular clause in this manner. It's not defined in the Act. But the explanation to which is there, to the business connection, to the section 911, it provides that the business connection includes certain kind of the activity. So what does explanation 2 provides is, let's have a look at it. This is the explanation 2 to section 911. What does it provide? That the business connection for the removal of the doubts, it is hereby declared that the business connection shall include any business activity carried out through a person who acting on behalf of the non-resident. So, business connection will include any business activity carried out by a person who is acting on behalf of the non-resident, and that concludes the contract or habitually plays the principal role leading to the conclusion of the contracts by that non-resident. What does this mean? Let's try and break this particular definition. So, first part, what does it say? That habitually exercises in India an authority to conclude the contracts. Let's understand this by way of an example. Let's say there is a US company. Now it wants to engage in Indian market. Now before it could venture into the Indian market, or in order to, before it establishes its proper business in the Indian market, what it thinks is that, okay, let me first talk to the people who are locals over there, because this is a US company, right? It may not have knowledge about what are the preferences of the Indian market, how the customers react to the products. So what it does is, it will contact to a local person who has an experience in, let's say, who has the experience of the Indian business market. Now it reaches out to a particular person who is a dealer. Then look, we are into manufacturing of these sports shoes. Now, we want you to undertake the sales on behalf of us. Right? So it will reach out to that particular dealer and say that, look, this is the shoes which we have manufactured. And you take the dealership of this particular shoes. You would be the exclusive dealer, let's say. And you carry on the sales in respect of these shoes. Now, this person will undertake the sales on behalf of the foreign company. Right? So, this person is acting as an agent of the foreign company. Now, he has an authority to conclude the contracts on behalf of the foreign company. What do we understand by concluding the contract? Well, he would be negotiating the price. He would be finally saying the yes to the customer. He would be entering into a contract for the shoes. We would not enter into any kind of contract, but he is concluding the deal. Right? So he has and habitually exercises. He not only has the authority, but he also habitually exercises that authority. It's not only necessary that I should have the authority. I should be also habitually exercising. Habitually means regularly I should be exercising. It should not be a one-off case. See, one-off case is never a business connection. It's an isolated transaction or non-routine transaction or exceptional transactions would not result in any business connection. I hope you understand that very well. Because that's a one-off case, right? So that does not lead to a business connection. Business connection means what? That the other party which is there, the non-resident company which is there, is engaged in interaction of our business. Or is it interaction with the economy? It is using the resources of the economy. It is doing the business there by being substantially present. That is the meaning of business connection. A real link is being established between the business activities which are carried out and the income which is generated. So there could be a possibility, let's say, for example, there are exports made by, let's say, Amazon. Or let's say any other foreign company. There are exports which are made by the foreign company. Now, there could be one export, let's say, for example, Rolls-Royce, Lexus car. Do you see often these cars in the Indian market? Answer is no. Are there dealers present in the Indian market? Answer is no. There could be one of the transaction, let's say, or maybe 10 cars which would be owned in India by few people. Now, that does not result in a business connection because these are isolated transactions. They are not carrying out the systematic activity in India for the business. So, there is a weak link which is present between the income which is generated and the business activity which is being carried out. That does not result in a business connection. Although business connection is not a defined concept, it's a very wide term. It could include anything. But the courts have interpreted that there should be a substantial link between the income and the business activity which is being carried out. Fine. So unless the non-resident has a business activity in the other country, in India, until then the business connection is difficult to establish. So there is a difference between doing business in India versus doing business with India. Understand the difference. The term in and with has a huge difference. What do I understand by doing business with India? Meaning I'm not carrying out the business activities by remaining engaged in India. I'm just making the sales by remaining outside India. So I'm doing business with India. There is a weaker link which is there between the business activity and the income which is being generated. So that does not result in any kind of business connection. So when I say that I'm doing business with India, there may not be any business connection. But now, if I say I'm doing business in India, meaning I am carrying out the business activities in India and the income is getting generated therefrom. So there may be a business connection in that particular case. Are you getting that? So now let's say, for example, I'm not doing business activities myself, but I'm appointing an agent to do the business activities on behalf of me. Under the Contract Act, you would have studied that what an agent does on behalf of the principal will bind the principal. It is as good as if the principal is doing himself. Right? So the agent is the representation of the principal. What the principal would have done directly, he is doing indirectly through an agent now. So agent is the representation of the principal. Right? CPT, you would have learned, right? Under the Indian Contract Act, though you may not remember now, right? So therefore, if I'm not doing activities directly, but through an agent who is concluding the contracts habitually, that would result in a business connection. What does the second part say? Or habitually concludes the contract. So first part says has and habitually exercises in India authority to conclude the contract. So either he has the authority to conclude the contract and he habitually exercises that authority, or he does not even have the authority but he habitually concludes the contract directly. He may not be authorized by the foreign company, but he is habitually going ahead and concluding the contract. Or habitually plays the principal role leading to the conclusion of the contracts by that non-resident. What does this mean? So see, prior to 2013, the tax treaties have the similar language, except this particular point. So the tax treaties most of the time have the similar language, has and habitually exercises in India and authority to conclude contracts, or habitually concludes the contract. So the MNCs are very smart, right? What they do is they have these contracts designed in a way that they will not give any authority to agent to conclude the contract. The agent will substantially do everything. They will ask the agent, okay, you go, you decide the pricing, you negotiate the pricing with the customer, you do the marketing. But when it comes to conclusion, you say yes to that particular customer that, okay, yes, we will make a sale to you. But do not, enter into any kind of contract with him. The contract will be approved by us. You will decide pricing, you will do marketing, you will do sales promotion, everything will be done by you. But when it comes to the conclusion of the contract, we are interpreting this particular clause so literally that you give us the signing of the contract. The final document will be signed by the foreign company. You will not sign that. And we will not have then any dependent agency, or in that particular case, there will not be any business connection. And therefore, our entire income will be exempt. Because if there is no business connection, there would not be any income deemed to accrue or arise in India. Very simple. But the government is more smarter. They realize that these MNCs have been deploying these kind of tax avoidance strategy to avoid establishing the business connection in the source country, or rather, let's say, here in India. So the OECD, which is the body which, kind of develops the policies on international tax. The OECD assists in developing the policies on international tax. It's an intergovernmental body, which is Organization for Economic Cooperation and Development. It's an intergovernmental organization with many member countries, especially the developed countries. Now, this particular body is responsible for formulating the policies on the international taxation. So, OECD, along with the G20 member countries, India is a G20 member country, right? So, OECD, along with the G20 member countries, had devised the base erosion and profit shifting action plan. India is not a member country of OECD. India is in fact now heading the presidency of G20. So it's a part of G20 group, right? So OECD along with the G20 nations devised this BEPS action plan, base erosion and profit shifting. As the name suggests, base erosion these MNCs, by deploying these strategies, resulted into the tax base erosion of the countries and profit shifting. Now, if you see here also, if these MNCs were interpreting this clause very literally, this was resulting in profit shifting because the profits were not getting taxed in India, even though the business activities were being carried out substantially in India. So base erosion and profit shifting action points or action plans were being developed to target different tax avoidance strategies by the MNCs. One of the action plan was Action Plan 7, which was for the permanent establishments. What do we understand by permanent establishment? Permanent establishment is a treaty term. Under the Act, you use the terminology business connection. Under the tax treaty, for the taxability of the business profit, you use the term permanent establishment. It's not exactly same as business connection, but it's an equivalent term of business connection. Permanent establishment is in fact a very defined concept. If you see business connection, it's not defined. But permanent establishment is a very well defined concept. Under the tax treaty, we use the term permanent establishment instead of business connection. Right? So, like for example, under the Act, the business profits will be taxable only if there is a business connection in India. Under the tax treaty, the business profit will be taxable only if there is a permanent establishment in India. So, Action Plan 7 was for permanent establishment. The tax avoidance through the permanent establishment which was happening. So Action Plan 7 was to target that. And this particular clause was being added to it. What was this clause or this particular addition was being made? Habitually plays the principal role leading to the conclusion of the contracts by that non-resident. So the agent is not concluding the contract. He doesn't have the authority to conclude the contract, but he plays the principal role leading to the conclusion of the contracts. In that case also, there will be business connection. So India has adopted that recommendation as a part of our Income Tax Act, and that's how you see this. Is it clear till now? Any questions, any doubts do you have in understanding this? Any doubt? Purushottam, no, this may not be the employer-employee relationship. An agent may not have that kind of employer-employee relationship. He may not be the employee. But he is dependent agent because he is functionally only performing for one principal, let's say, or his substantial activities are for one particular or exclusively for one principal, or maybe say 90% of his sales are for one particular principal. Clear? So he's a dependent agent. Fine. Okay. Then the second part says, and the contracts are in the name of the non-resident for the transfer of the ownership of or the granting of the right to use property owned by that non-resident or that non-resident has the right to use. So the contracts are in the name of the non-resident, or these contracts are for the transfer of the ownership of any property which is owned by the non-resident. So the contract could be either for the transfer of ownership of any property, or the contract could also be for, let's say, the use of property. It could be a contract for, let's say, the leasing. It could be a contract for transfer of the property, which is for the sale of property. It could be the contract for sale, or it could be the contract for leasing. Both are covered over here. Fine. Or for the provision of services by the non-resident, which is simple. Clear up till this much? Okay. Next point. So the first is dependent agent is constituted when he has habitually authority, and he exercises that authority as an authority, and he habitually exercises an authority to conclude the contracts, or he concludes the contracts habitually, or plays the principal role leading to the conclusion of contracts. Second, has no authority to conclude the contract, but habitually maintains the stock of goods. He habitually maintains a stock of goods from which he regularly delivers the goods on behalf of the non-resident. He doesn't have any authority to conclude the contract, but he is maintaining the stock of goods from which he is regularly delivering the goods. So he is not concluding any contract. Let's say he is just a stockist. He is maintaining the stock of goods on his display, and he is regularly delivering therefrom. The contracts may be concluded with the foreign company itself. Fine. Habitually secures the order in India. Third is habitually secures the orders in India mainly or wholly for the non-resident. So he is securing the order for the non-resident, mainly or wholly for the non-resident, or for that non-resident and other non-residents controlled by or subject to the common control as that non-resident, meaning for that non-resident and his related parties. So if he secures the contracts habitually, or he habitually maintains the stock of goods and regularly delivers from that stock, or he has an authority to conclude the contract which he habitually exercises or plays a principal role in leading to the conclusion of the contract, then in that particular case, that is resulting in business connection. Yes, franchising can result in it, but that depends that whether in that particular case, the franchisee which is operating is acting as a dependent agent or it is taking in its own name independently. Most of the time, these franchisees which are there, they are independent entities. They are not the dependent agent. These are the independent, let's say the companies which are incorporated. They are representing the foreign company, of course, but they are operating in their own capacity. If you see the franchisee agreements which are formed, they are worded in such a way that these particular entities which are there are more or less the independent in nature. So franchises which are formed, of course, if the terms of the franchisee agreement which is there, that could result in sometimes dependent agency P or the dependent agency which may result in the business connection in India. So that could result in the dependent agency, but most of the time it is worded in a way that these franchises which are there, they are not concluding the contracts on behalf of the or playing the principal role in conclusion of the contract on behalf of the non-resident. The safeguards which are provided in the franchisee agreement, they are just for ensuring the brand value of the franchisee. There are no other controls. So these are operating independently. There may be certain controls in the franchisee agreement. So that controls or restrictions which are provided in the agreement are only to safeguard the brand value of the franchise. But that does not lead to the fact that there is a business connection directly. Clear? Any other question? Yes, any other question? Is this clear? Fine? Okay. So this is the first part. Are we clear? Now, secondly, there is an exception to this dependent agency. There is an exception to the dependent agency. And what is this exception? The business connection will not include any business activity carried out through a broker, general commission agent, or any other agent having an independent status, if he is acting in the ordinary course of business. So, exception to this is an independent agent acting in ordinary course of business would not constitute business connection. The proviso to this section talks about it. So an independent agent, meaning who is operating independently, who is not controlled, who is not subject to the restrictions of the company, foreign company, that would not constitute the dependent agent. He would be considered as an independent agent. So, in case an agent is operating independently, he is working for different principle, and he is not subject to any restrictions of the foreign company, he is not subject to terms and conditions, he is not being controlled by the foreign company, then he is considered as the independent agent. And if he is operating in the ordinary course of business, then in that particular case, that would not constitute the business connection. Are we clear? Fine. Further, the Act also provides that the broker or the independent agent who is, or the any other agent who works mainly or wholly on behalf of a non-resident or a non-resident and his related parties will not be considered to be an independent agent. So who is not considered as an independent agent? An agent who is working wholly or mainly or wholly on behalf of non-resident. Agent who is working mainly or wholly on behalf of non-resident is not an independent agent. So let's say, for example, if he says that, okay, I am an independent agent, but he's working only for one particular company, or mostly his sales are for one particular company. Let's say he has 100% sales, out of which 90% are for one company. Then in that case, he would not be considered as an independent agent. Clear? Any doubt till now? Purushottam, in franchise agreements, suing the brand name or using the brand name of the non-resident doing the business in India as if franchise income is taxable. Yes, it is taxable. Franchise income is taxable in India. It is not a capital receipt. It's a normal receipt which is there. So that is considered most of the time as a royalties income using the brand name. Yes. Okay. Any other question? Yes. Any other doubt? Any question? Yes or no? Is it clear? Business connection portion, this much is clear. Yes or no? Okay. Now, one more important thing under the business connection, which is again a very new part which is there. So, under the business connection, there are certain exclusions and there are certain other inclusions. What are the exclusions and what are the inclusions? So, for the business connection, the exclusion first we'll talk about the inclusion. Let's talk about first the inclusion. So there is another explanation 2A which is introduced. What it provides is that the business connection will also include significant economic presence of a non-resident in India. So business connection will include, first of all, I'm just making a chart over here for your easy reference, a dependent agent will exclude the independent agent, other than one working mainly or wholly for non-resident. And dependent agent is who habitually exercises authority to conclude the contract, or plays principal role leading to conclusion of contract, secures the order mainly or wholly for non-resident, habitually maintains the stock and delivers therefrom. Fine. So also here you can write habitually secures the order. Not just secures, but habitually secures the order as well as habitually plays the principal role. Okay. It also includes significant economic presence. This is your explanation 2, and this is your explanation 2A. What does it provide? So explanation 2A says that significant economic presence of a non-resident shall constitute business connection. And what does significant economic presence mean? Significant economic presence will mean, so let me just put it for you, explanation 2A. Transaction in respect of any goods. Transaction in respect of any goods. Sorry. Yes. Transaction in respect of any goods, services or property carried out by a non-resident with any person in India, including provision of download of data or software in India, if the aggregate of payment arising from the transaction during the previous year exceed the prescribed amount. So first we'll try to understand what does it say. Transaction, nature of transaction is what? In respect of any goods, services or property. Transaction in respect of any goods, services or property carried out by a non-resident with any person in India. It doesn't say transaction of goods or transaction of any goods. It doesn't say like that. It says transaction in respect of any goods, meaning it could be any transaction. Let's say marketing activity also. It doesn't say transaction of goods. It says transaction in respect of any goods, services or property carried out by a non-resident with any person in India, including the provision of download of data or software in India, where the aggregate of payments arising from the transaction exceed the amount. So the nature of the transaction is this. This is your nature of transaction. So let me break it like this. This is my nature of transaction. Right? So this is the nature of transaction. And the threshold is given separately. What is the threshold? If the aggregate payments arising from the transaction during the previous year exceed the amount. What is the amount prescribed? 2 CR. So if the aggregate of payment arising from such transaction exceed rupees 2 CR. Exceed rupees 2 CR. That will result in significant economic presence. Second one, systematic and continuous soliciting of business activity. Systematic and continuous soliciting of business activities or engaging in interaction with the such number of users as may be prescribed. So what it says is, again here, I'm removing as may be prescribed, but the transaction, what it is saying, systematic and continuous soliciting of business activity. Now, what do we understand by soliciting of business activity? So, soliciting of business activity means that offering these services, continuously attempting to persuade the customers to buy or procure a particular service. So, systematic and continuous soliciting of business activities. Let's say, for example, if you see, let's say, for example, today morning you may be searching for, let's say, Adidas shoes in, let's say, Myntra, or let's say on Amazon. Now you went to Google and you search for, let's say, direct tax books. Now let's say you had gone to one of the website. Right on that website, in the right hand corner, you would see either the direct tax books, the advertisement of that, or you may see the Adidas shoes which are there, and you will just go and click at it because you are being continuously persuaded to buy that product. So that is the systematic and continuous soliciting of the business activity or interaction with the users in India. And for that, the threshold is the number of users should be at least 3 lakhs. So, users greater than equal to 3 lakhs. So, then there will be the significant economic presence. Now, what is this exactly, ma'am? We are still not very clear about what you're talking. Because this significant economic presence is something we are not persuaded with, right? Yes, I understand and I completely agree. I'll explain you. See, if you see the business connection, when I was talking to you, the first thing what I said to you when I started explaining the business connection part, that there is a difference between doing business with India and doing business in India. The business connection denotes that you are doing the business activities in India. There is a connection between the business activities and the income which is getting generated therefrom. Right? So, business connection denotes the some amount of the physical business activities being performed. Even having the dependent agent means that you have some physical business activity through a person. Now, digitalization has blurred this concept of doing business in India versus doing business with India. Now, you can remain completely outside India and do a business. Look, I am sitting somewhere. You do not know my location. I may be sitting, let's say, from London and taking your classes. So, therefore, it is quite possible now to provide the services, to sell the goods from any place in the world. Because of the digitalization, the world has shrunk. So, therefore, the presence which was there, the physical presence which was there is no more required. But the traditional concept of business connection still demanded the physical presence for the purpose of taxing the income in India. Isn't it? So because of which the countries were losing out on the revenues year on year. In fact, even are losing out revenue year on year. Because of the reason that the existing tax concepts, the existing source principles still require the physical presence in order to accrue, in order to provide for accrual of income. The income is not even accruing in India because the accrual concept requires that the physical activities are being carried out. Therefore, the OECD G20 BEPS Action Plan 1, which was for the digitalization of economy, to tackle the tax avoidance resulting from digitalization of economy, suggested that the countries introduce the interim measures till then something is finalized. One of the interim measures was introducing the concept of significant economic presence. What is significant economic presence? That you are not present in the country, but you are significantly interacting with the country and remaining present economically in the life of the, economically in the other country. So there is a significant economic presence and not a physical presence. If you see all these transactions which are there, the first transaction in respect of goods, including the provision of download of data. Your data is being collected every minute, every second. Whatever you are browsing, whatever you are putting on the search engine, whatever you are putting on the Instagram or YouTube, your data is being sold every second to these companies. So therefore, there is a kind of interaction with the economy, which is not a physical interaction, but an economic presence, which is significantly there. That is what is the significant economic presence. So explanation 2A says that significant economic presence would constitute the business connection. And what is significant economic presence? The nature of the transactions are given here, along with the threshold which is prescribed. Is it clear till now? Any questions? Purushottam, we'll talk about equalization levy later. Yes. Equalization levy is a different concept than SEP. Equalization levy is another interim measure which was suggested by OECD, which also India has adopted, but we are going to deal with it or touch upon little later. Fine. Any other question? Okay. So this is your business connection, which are the inclusions which are provided under section 9. Right? So first is the dependent agency, and now we have the significant economic presence. Again, a proviso to that provides that the transaction or activities shall constitute the significant economic presence, whether or not the agreement for the transaction or activities is entered in India, whether or not the non-resident has a residence or place of business in India, or the non-resident renders these services in India. Meaning what? That the SCP will be constituted no matter whether the agreement for the transaction is entered in India. The agreement may be entered outside India, so that one may not just contend that the agreement is not in India, therefore the income source is not in India. So that contention is ruled out. Whether or not the non-resident has any residence or place of business in India, again, it doesn't matter. Even if the non-resident does not have any place of business in India, that's fine. Because we want to capture the transactions in a case where the non-resident is operating without a place of business. So you will not be able to take that contention that the non-resident does not have any place of business in India and therefore there is no source. Whether or not the non-resident renders the services in India, doesn't matter whether or not you're rendering any service. Rendering means you're coming in, providing the service here. Doesn't matter. You're rendering the services from outside India. That's fine. So that is just a clarification. Fine. Now, another important point. Now we have one more important point over here, that let's say, for example, once I see that there is a business connection in India, either because of, let's say, dependent agency, or let's say because of significant economic presence, or even there can be business connection otherwise also. It's not necessarily that there can be business connection only because of these two, because it's a very wide term. Now, let's say I have the sales of 1 CR being made in India, and that has resulted in business connection in India. Will entire 1 CR be taxable in India? The answer is no. The answer is completely no. Why? See, sales, when I talk about sales, we all understand that the profit which is there, that will be taxable. Isn't it? We never tax the sales. We tax the profits. Isn't it? So if I have sales of 1 CR in India and I have the business connection being there in India, my 1 CR will not be taxable. The profits which are there will be taxable in India. Fine. Now let's say the profits are, let's say, 40 lakhs. Will my 40 lakhs profit will be taxable in India? The answer to that is again no. Why? See, profit is always a function of demand and supply. Economics. Again, going back to CPD. So all the concepts that you learn during your CA course in entirety are very important, right? So your profit is a function of demand and supply. There is a demand in India, that's why you're making sales in India. But whether entire supply function is being carried out in India. So when I talk about, I have, let's say, the sales of let's say $1,000. Now out of this $1,000, let's say my profit is, let's say, $400. Now this particular profit is the function of supply and demand, right? My demand is represented by the sales. But my supply may have several factors, which is, let's say, the manufacturing, then the, let's say, marketing, then let's say the processing, let's say the finance, let's say the final deliveries. Many aspects are involved. Now, it is very much possible that the manufacturing is not carried out in India. Let's say Nike shoes, Adidas shoes. Are they being manufactured in India, or are they just being sold in India? Procured and sold. They are not manufactured in India. So therefore, the entire operations are not carried out in India. So this $400 profit which you are seeing is not only resulting from the sales or from the procurement. This $400 has several components. There may be the interest which would be paid for financing this particular entire manufacturing operation to make the sale of $1,000. There may be the marketing activities which may be carried out, let's say, from Singapore. The processing, let's say, operations from India, and then there is a sale. So the entire $400 cannot be taxed in India because not all the operations, not all the activities are being carried out in India. Are we getting this much? Yes or no? Are we clear till this much? Yes or no? So the entire transaction which is there, or the entire business activity which is there, is not taking place in India. So what explanation one provides is that where all the operations are not carried out in India, the income from the business shall be only the income as is reasonably attributable to the operations carried out in India. So, the income deemed to accrue or arise from the business connection income deemed to accrue or arise from the business connection shall be only the income as is reasonably attributable to the operations carried out in India. Are we clear? Fine. So out of this $400, we will find out what are the activities which are carried out in India. Let's say only the procurement is done. So let's say out of which if the approximate profits which should be attributed to this particular activity, let's say should be $100. So only $100 will be taxed in India. So the income which is attributable to the operations carried out in India shall be deemed to accrue or arise in India. Are we clear? Any doubt? Any questions? Any doubt till now? Yes or no? Okay. Now, one more important thing on this particular point. The income attributable to operation carried out in India. There is another explanation, which is explanation 3A. Now, explanation 3A, which is there, it provides that this will include the income which is attributable to the operations carried out in India will include the income from these particular transactions. What are these transactions? The advertisement which targets a customer who resides in India or a customer who accesses the advertisement through internet protocol address located in India. So the income from the Indian operations, or this will be considered as the income attributable to the operations carried out in India. These will be considered as these operations are Indian operations. These activities are Indian operations. This will be deemed, because otherwise there is no direct principle which says that these are the direct Indian business operations. One can say that just because I'm targeting the advertisement to your resident, Doesn't mean that this is Indian profit or Indian activity. But there is a deeming fiction which is created under the law. Deeming fiction means what? What is not there is deemed to be there and therefore it will be there. Are you getting it? So something is not there. I am deeming it to be there and therefore it will be there. So the income from the advertisement which is targeting a customer who is residing in India. If I'm a non-resident, I'm generating some income by targeting the advertisement towards the customer in India. Let's say Google is earning from the advertisements because Google targets you this advertisement every time. The exact example what I told you. Or a customer who will not be a resident of India, who is sitting outside India, but he is accessing the advertisement through the internet protocol address, IP address located in India. Second, sale of data collected from a person who is residing in India. So any income, let's say for example, Google collects the data all the time. YouTube collects your data all the time. These apps like let's say Myntra, Flipkart, Amazon are collecting your data. They are then selling this data. How is Instagram functioning? How is WhatsApp functioning? You're just observing the reels on Instagram, but have you ever noticed why is this company, nobody gives you anything for free? Why is this company giving you all the content for free? It's not giving you for free. You're paying a big price for that reels which you're watching on Instagram. And the price is your personal information. How do you get to watch reels on Instagram? The reels which I watch may be very different from the reels which you are watching. You are being directed particular reels because what you are watching, that information is processed and then you are directed the same kind of information which is there. Because your data is being sold. So if there is income from the sale of a data which is collected from a person resident in India or any other person who uses the IP address in India, that will be the income considered as income from the operations in India. Or sale of goods or services using the data collected from a person who resides in India. So let's say, for example, there is no income sale of data, but there is income from the sale of goods. But these sales were being made because the data was collected from a person resident in India or a person who used the IP in India. So this data, when it is collected, what is the use of this data? This data is very valuable information because then I can analyze this data and direct this particular sales to you. So then in that particular case, if that is the case, the income from that particular sale of goods or services also will be deemed to be attributable to the operations carried out in India. Are we clear? Any questions, any doubt? If a foreign company has a manufacturing unit in India but no sales made to India, can that company claim cost as losses in India if it satisfies a significant presence in India? Yes, it can claim the losses. Why not? It cannot claim. If it has the business connection in India, it can very well claim the losses. If it is doing the manufacturing, if it is incurring the losses, that's fine. Yes. Okay. So now the exclusions to the business connection definition. There are certain exclusions. Now, what are the exclusions? Let's write it. So this were the inclusions. Now I'm writing the exclusions besides this only. What are the exclusions? The operations the income from the operations which are just confined to the purchase of goods for the purpose of export. So where there is purchase of goods for the purpose of exporting outside India, no income will be deemed to accrue or arise in India from the operations, from such particular operations. So exclusion is purchase of goods for export. So not only purchase, but purchase for the export. In case of a non-resident who is engaged in the business of running a news agency or of publishing newspapers, magazines, or journals, if the activities are confined to collection of news and views in India for the transmission out of India, again then from that any income will not be deemed to accrue or arise in India. So the operations where the activities are confined to the collection of news for transmission outside India for a non-resident engaged in, for non-resident news agency or a publishing house. Fine. Third, in case of a non-resident who is not a citizen of India, or a non-resident partnership firm which does not have any citizen partner, Indian citizen or Indian resident partner, or any company which does not have any Indian citizen shareholder or Indian resident shareholder, and their operations are confined to the shooting of cinematograph film in India, then there will be no income deemed to accrue or arise in India. So third one is shooting of cinematograph film. Topic film for non-resident individual not citizen of India or firm having no Indian citizen or resident partner or a company having no Indian citizen or resident shareholder. Fine. And finally, the foreign company engaged in the business of mining of diamonds. No income will be deemed to accrue or arise in India if the activities are confined to display of uncut and unassorted diamond in the special zone notified by the government. So, last one. Income from the activities confined to display of uncut and unassorted diamond for company engaged in mining of diamonds. Fine. Any doubt, any questions? Yes or no? Yes. Is this clear? Is business connection entirely clear? Fine. Okay. So once again, just a quick recap. Business connection, not a defined concept. We have the explanation two, which includes the dependent agent. Dependent agent one, who is habitually exercising the authority to conclude contract or habitually concludes the contract, or habitually plays the principal role leading to conclusion of contract, or habitually maintains a stock of goods and delivers therefrom, or habitually secures the order. It does not include an independent agent who is acting in the ordinary course of business. Other than who is not considered as independent agent, one who is acting or working for mainly or wholly for the non-resident. Fine. Then it also includes the significant economic presence. Now, what is significant economic presence? Transaction in respect of any goods, services, or property, including the download of data or software in India, where the aggregate of the payments exceed rupees 2 crore, or systematic and continuous soliciting of business activity, or engaging in interaction with the number of users exceeding 3 lakh. Now, these transactions, whether the all the profits are attributable, no. The profits only with income which is deemed to accrue or arise in India will only include the income from the operations which are income which is reasonably attributable to the operations carried out in India. Now, this will also include the income from the advertisement which targets a customer who resides in India or accesses the Indian IP, or sale of data collected from a person resident in India or from any person who accesses Indian IP, or sale of goods or services using the data collected from a person who resides in India or person who accesses the Indian IP. Clear? And then there are these exclusions, which is purchase for the purpose of export, display of uncut and unassorted diamonds, collection of the news for the purpose of transmission out of India, or shooting of cinematographic films. Fine, yes or no? Purushottam, I didn't get your question. It is drawback in the act to avoid taxes are. Is it covered under the explanation number one? I didn't get your question at all. Can you elaborate it, please? Okay. Any other doubt? Any other question? Fine. So shall we take a small break? Purushottam, I'll answer your question upon the application of Manjula Shah case by the SSC while calculating the capital gain income. AO can invoke GAR provision subject to complied of other provision on the view that this judgment was given by the Bombay High Court as a view of other High Court orders are bound to the lower authorities under the jurisdiction where the High Court. Is it a tax evasion? No, why? How is it tax evasion, Purushottam? The application of Manjula Shah judgment, this just says that you have to take the indexation from the date the asset was or the year when the asset was first held by the assessee, by the previous owner. So, therefore, in that case, this is just a kind of interpretation of the law. How is it a tax evasion? And why the GAR would be invoked in this particular case? There would not be any invocation of GAR. Okay. Okay, let's take a small break of 10 minutes and then we get back. Yes, students. Purushottam, High Court orders are bound by the High Court of that jurisdiction and not bound by other jurisdictions. So, application by some other jurisdiction, is it tax avoidance? No, it's not tax avoidance. Tax avoidance means that you're finding out the loopholes under the tax law and exploiting that particular opportunity, which is not in as per the intention of the law, but you are literally interpreting the tax law. Like the example which I gave you, that if the agent is not concluding the contract but doing everything else. So the MNCs were taking the view that, okay, this is something which is not resulting in business connection. That is a tax avoidance, not that High Court order is given and you are in compliance with the High Court order. And in the other country, if in the other state, if the High Court order is not there, but still you will be bound by that other High Court order, because if your jurisdictional High Court is not there, but some other High Court has given the judgment, you'll be bound by that. That's not a tax avoidance. Okay. Okay. So now let's proceed further. The next part is again under section 911. If we see, what was the second part? We are still under 911, right? So one was business connection. Second is property, income accruing or arising directly or indirectly through or from any property in India. So, or from any asset in India. So what does it mean? Let's say, for example, that I have a rental property in India. Okay, I have a property which I would want to give it on rent. Now, let's say, for example, I've been finding out the tenants for this particular property, but I've not been able to find out for the reason that somehow that nobody is available to find my property, right? Or to get my property. And suddenly I was a non-resident. I got one friend in, let's say, US, whose parents were also searching for property in India, whose parents were based in India. Now I enter into a rental agreement with that non-resident because he would be paying rent on behalf of his parents. So now the contract is outside India. The rental agreement is entered into outside India. The amount is paid outside India because the friend who is there in non-resident, who is there outside India as a non-resident, will be paying. So the contract is outside India. The consideration is paid in foreign currency. So whether in that case one can say that the income accrue or arise in India, the answer is no, because the income accrues where the contract has been entered into. In this particular case, the contract has been entered into outside India. But what does section 911 says? Section 911 clearly says that if the income is accruing or arising directly or indirectly through or from any property in India. Now the property is situated in India. The income is accruing or arising therefrom. So the rental income will be deemed to accrue or arise in India, or through or from any asset. Similar is the case with any other asset which is located in India. Clear? Or any source of income in India. So any income which is having the source in India, that is deemed to be accrue or arise in India. Any interest income, rental income, whatever. Okay. Next one is very, very important, which is again, there is a development in that. Through or from or through the transfer of a capital asset situated in India. Now let's say if the property is situated in India, but I sell to another non-resident. But I'm also non-resident, I'm selling to another non-resident. Again, the contract is concluded outside India. The consideration is paid in foreign currency. So therefore, technically the income is accruing outside India. But if it is from the transfer of a capital asset situated in India, then it will be deemed to accrue or arise in India. Now, what is important over here is the explanation which are provided in relation to this. What are the explanations which are provided in relation to this? Let's try and understand one by one, because there is something called as indirect transfer of assets, which is what we are going to spend now our considerable or the rest half of the class on this particular portion. What is it? We have seen explanation up till 3 and 4. 2, 3 and 4 we have seen. Okay. So 2 and 3 we have seen. Now we will see the explanation 4 to explanation 7, which is in relation to this particular portion, which is there. Fine. Now, understand one particular thing. Here, what does it say? Income from transfer of a capital asset situated in India. Now, I'll show you one scheme of tax avoidance, which was also the famous Vodafone case. What had happened? Let's say there is a company AINC. This is a US-based company. It has incorporated a subsidiary, let's say ABINC, in, let's say, Mauritius. That has another company, AB Limited, which is an Indian company. Now, if AINC would have sold the shares of AB Limited, or if AINC would have directly invested in AB Limited, and if it would have sold the shares of AB Limited, there would have been taxability of the capital gains in India as per the India-US tax treaty. If, let's say, this was the direct investment, and let's say this was sold, then as per India-US treaty, capital gains will be taxed in India. So what it did was, it incorporated a subsidiary in Mauritius. Instead of this route, it applied this particular route. Now, what it did was, instead of selling the shares of AB Limited, it sold the shares of AB INC Mauritius to, let's say, BINC, another US company. So this sale of shares of the Mauritius company, the transaction has taken place outside India. Agreement was outside India. The transaction is between two non-residents. The sale of the asset is outside India. The asset is shares of a foreign company. Consideration is in foreign currency. So therefore, no income is accruing or arising in India. No income accrue or arise in India, isn't it? But the Indian tax authorities observe that this is clearly a tax avoidance scheme. How? If you see, the Indian tax authorities lifted the corporate wheel and noticed that in the balance sheet of AB INC Mauritius, in the balance sheet of AB INC Mauritius, the share capital was held by AINC, and there may be just few assets, let's say, or let's say some, I'll not write fixed assets only, but I'll just say assets. And the major assets were the investment in AB Limited. Now, AB Limited is an operational company. These kind of companies are known as special purpose vehicles, SPV. So the only purpose of incorporating AB INC was to avoid the capital gain tax in India. The shares of AB INC were deriving their value from the investment of AB Limited, from the shares of the Indian company. So the business of this Hutch India, which was in the Vodafone case, was as and when it was progressing, the value of the shares of this company was increasing because the investment, let's say this company is progressing. So the shares, value of this shares will go up. If the value of the shares will go up, the investment here will go up, and therefore the share price of this company will also go up. Isn't it? So the shares of the ABINC, if it was deriving the value from the investment in the Indian company, the Indian tax authorities contended that this particular transaction should be deemed to accrue or arise in India. Supreme Court did not accept the tax authorities' argument on the ground that, or on the contention that there was nothing under the income tax law to provide this kind of source rule. Here the shares were of the foreign company. How can you say the shares of the foreign company will be deriving the value from India without having an explicit provision on this particular point? So the Supreme Court clearly rejected the tax authorities' argument and held that unless and until there is a provision under the income tax law, such a contention cannot be made. Income tax authorities said, okay, fine. They made a retrospective amendment. And what is that amendment? Let's try and understand. So the explanation 5, which is there, it provides that an asset or a capital asset, being a share or the interest in any company or entity registered or incorporated outside India, shall be deemed to have been situated in India. So what does it say is explanation 5 provides that the share or interest in a foreign company or entity deriving its value derives its value directly or indirectly, substantially from the assets located in India. Substantially from the assets located in India, then in that particular case, the share of the foreign company will be deemed to be situated in India. Share of foreign company deemed to be situated in India. So what is happening here? Here what they are saying, that if the share of this particular company is deriving the value from the investment or from the assets located in India, directly or indirectly, then the share of this foreign company, this share will be deemed to be situated in India. Now, if it is deemed to be situated in India, what will happen? This income from the transfer of this share will be considered as the income deemed to accrue or arise in India. What did section 911 provided? Income from the transfer of a capital asset situated in India. So therefore, if the share of the foreign company is deemed to be situated in India, then the income from the transfer of that share of a foreign company, will be deemed to accrue or arise in India. Are we clear? So this is what is amendment which is made under explanation 5. Explanation 5 provided that the asset being a share of a foreign company, will be deemed to be situated in India if the share derives its value substantially from the assets located in India. Are we clear? Any doubt, any question till now? Yes? Any doubt? Okay. Then, what do we understand by the asset deriving its value substantially from the assets located in India? How do we determine that? So for that matter, we have explanation 6. What do we understand by deriving its value substantially from the assets located in India? What do we understand by the term substantially? How do we determine that? So, substantially means how do you determine that? It means the value of the Indian assets. Value of the Indian assets. So, value of the Indian assets, the share or interest, when we are saying, shall be deemed to derive its value substantially from the assets located in India. When we can say that if the value of the Indian assets exceeds rupees, or I can just write it, greater than rupees 10 crore. And there is an and condition, not or. Represents at least 50% of the value of all the assets owned by the foreign company. Represents at least value of, or represents at least 50%, represents at least 50% of the value of all assets owned by foreign company or entity. Okay. So when can we say that the value of the shares of the foreign company derive their value substantially from the Indian assets? When you will be able to say that? So for the purpose of making that claim, we have to see the value of the Indian asset. We have to see the value of the Indian asset. Now, value of the Indian asset means what? The value of the shares of the Indian company exceed the amount of 10 crores and it represents at least 50% of the value of all the assets owned by the foreign company. So more than 50% of the assets of the foreign company should be the investment in the shares of the Indian company. And this has to be on the specified date. This is to be examined on the specified date. Now, what is specified date? We'll look into it. Fine. So, value of the Indian assets on the specified date. Now, value here means what? The fair market value. Fair market value of the assets without the reduction of liability. So, value means the fair market value without reducing the liabilities. Are we clear? So the value of asset means what? The fair market value of the asset without reducing any liability. So the fair market value, how do we compute that? The fair market value is provided in the rules. How do we compute that? That is provided separately in the rules. Fine. Are we clear? Any doubt till now? Any question, any doubt before we proceed further? Okay. Yes, Rule 11 UB has the provision to determine the fair market valuation. Okay. Fine. Now the next is the specified date. When do you have to examine the value? The value as on the specified date. Now what do we understand by the term specified date? The specified date we have to look into. Now what is the specified date? Again, the specified date is provided in explanation 6 only. It means, the specified date means the date on which, or let me just make a chart for you so that it's easier for you to understand rather than writing it down. Okay. If the book value on the date of transfer is greater than, if the book value on the date of the transfer is greater than 15% of the book value on the date of, or on the last date of the accounting period. Book value on the last date of accounting period. If the answer to is yes, then you have to take the date of transfer. In case the answer to this is no, then you take the date on which accounting period ends. Date on which the accounting period ends. Fine. So what is the specified date? Specified date means the date of transfer if the book value of the assets exceed by 15% of the book value on the date of the accounting period. Else, you take the date on the accounting period. Okay. So you have to examine whether the book value of the assets as on the date of transfer, whether it exceeds 15% by the book value as on the last day of the accounting period. If the answer is yes, then date of transfer. If the answer is no, then date of accounting, last day of accounting period. Are we clear? Any questions, any doubt? Without reducing. So you do not have to reduce the liabilities. FMV means the FMV of assets without considering the liabilities. And this is as per Rule 11 UB. Okay. Yes. Clear? Okay. Now there are certain exclusions again to this particular provision. And what are the exclusions? We will see that first. So there are certain exclusions that there are exceptions that this provision will not be applicable in certain cases. So what are the exceptions? Exception number 1. So this will not apply to any capital asset which is held by a foreign institution investor. So which is held by a non-resident by way of investment directly or indirectly in a foreign institutional investor or foreign portfolio investor. So this indirect transfer provision will not apply in relation to any capital asset which is held by a non-resident by way of investment in the foreign portfolio investor. So see what happens, what are these foreign portfolio investors? So foreign portfolio investors are basically the entities just like we have the mutual funds, right? So you make the investment, sorry, in the mutual funds, and then these mutual funds make investment in the equity shares, isn't it? Or in different classes of asset. Similarly, we have the foreign institutional and foreign portfolio investors. Now, the non-residents make the investment in the foreign portfolio investors, and then they make the investment in the shares of the other company. So now, if, let's say, for example, I am selling these shares or units in the foreign portfolio investment, then I will be attracted the capital gains in India, which is not the intention. This is not intended to cover the genuine transaction. This is a specific anti-abuse regulation. This is a SAR. So therefore, the explanation 5 will not apply to any asset which is held by a non-resident by way of investment under the foreign portfolio investor. So, okay, so you can write it down. The explanation 5 will not be applicable to any asset or capital asset held by a non-resident by way of investment directly or indirectly in FPI. Indirectly in foreign portfolio investor. Okay. This will not be applicable to the investment made directly or indirectly in the foreign portfolio investment. Fine. Second exception which is there, that is provided under explanation 7. That if the company, if the foreign company or entity does not hold the rights of management or control, if the foreign company or entity does not hold the right of management or control at any time in the 12-month period preceding the date of transfer, and voting power or share capital is not exceeding the 5%, and it is not holding the voting power or share capital or interest exceeding the 5% of the total voting power or the share capital, then the indirect transfer provision will not apply. Again, the intention of this is to exclude the small shareholders. Fine. So you can write down, if the foreign company does not hold individually or jointly with associated enterprise at any time in 12-month period or 12-month preceding the date of transfer, right of management or control, sorry, right of management or control, and voting power or share capital is not exceeding or is sorry less than 5% of total voting power or share capital. Fine. So these are the exclusion in this particular case. Any question? One more exclusion. That is not provided under the Act directly, but that is through a CBDT circular. So CBDT has clarified that the indirect transfer provisions will not apply in respect of any redemption done or buyback done of any share which is held indirectly through the entities incorporated outside India in the AIF, in the venture capital company, in the investment fund, in the venture capital fund. Because even that can trigger the indirect transfer provision. So if there is a buyback done or if there is a reduction of units done outside India, which had made the investments in the entities in India. So if that is the case, again, that is not the intention to capture here. So therefore, you can write it over here. Exception, CBDT circular has clarified that. This provision is not applicable to any income accruing or arising to a non-resident on account of redemption or buyback of shares of foreign company that is specified by the funds. Okay, so buyback of shares or investors held in carry, buyback of shares, you can buy held in carry in specified funds, like the venture capital funds. Okay, okay. Next is one important point before we close discussion on the indirect transfer. So see, if you see just this example, what we saw here, not if this particular API, let's say it declares the dividend. If it declares the dividend, whether the dividend will also be due to our just because the API derives from substantial assets in India. The answer to that is no. So CBDT has verified that the declaration of dividend by the foreign company outside India will not have the effect of transfer of India that has assets located in India. Therefore, the dividends declared and paid by the foreign company is the respect of the shares which derive their value from the Indian assets would not be deemed to be income accruing or arising in India. So you can write down here the dividend declared by the foreign company whose shares derive the value assets located in India will not be deemed to accrue or arise in India. Will not be deemed to accrue or arise in India by virtue of section 911. Yes or no here? Yes. Okay. Yes, Kaushiki, book value of the Indian assets or the total assets? Yes. Okay. Shall we solve one question on this indirect transfer? I'll give you the question. You have to solve it for me applying these particular principles. Okay. So just write down. Yes. ABC Limited, a company incorporated in Mauritius, is a wholly owned subsidiary of ABC PLC, a UK company. ABC PLC UK enters into a share transfer agreement with PQR Inc., a Singapore company, to transfer the shares of its subsidiary, which is ABC Limited in Mauritius. The agreement has been entered in UK. The agreement has been entered in UK. Sorry, PQR Inc. has provided or has discharged the sale consideration, in USD from its UK bank account. ABC Limited Mauritius has certain tangible or intangible assets located in India. The following information is provided. Particulars. Situation 1, situation 2, and situation 3. Okay. Date of transfer. Date of transfer 25th June 2022. 25th June 2022 and again 25th June 2022. Last date of accounting period 31st December 2021. 31st December 2021. And again, 31st December 2021. Book value of assets. Book value of assets of ABC Limited Mauritius on 25th June 2022. Located in India, rupees 56 crores, rupees 57 crores, and rupees 10 crores. Located outside India, rupees 58 crores, rupees 59 crores, and rupees 8 crores. Book value of assets of ABC Limited Mauritius on 31st December 2021. Located in India, rupees 60 crores, rupees 60 crores, and rupees 11 crores. Located outside India, rupees 40 crores, rupees 40 crores, and rupees 4 crores. Fine. ABC Limited Mauritius has liabilities pertaining to these assets, which are situated in India and outside India. Fine. There is no amalgamation or demerger of ABC PLC and XYZ INC. Because if there is amalgamation or demerger, remember there was an exemption under section 47. Even if there is an indirect transfer, right? So there was an exemption which will not be applicable here. ABC, sorry. ABC owns, ABC Limited or ABC PLC owns individually more than 5% of shares of ABC Limited Mauritius during 12 months before the transfer. However, it does not hold right of management or control in ABC Limited at any time during 12 months before transfer. Assume book value is equal to the fair market value. Determine whether the capital gain is taxable in India or not. Yes. So first tell me about situation 1. Yes. The question is before you. First situation 1. Yes. No, Kaushiki. Read the explanation 7 again properly. It's an and condition. It's an and condition, so this will not fall under exception. If there is no control as well as the shares voting power should be less than 5%. Both the conditions should be fulfilled. Your voting power is more than 5%. So both conditions are not fulfilled and therefore it will not fall within exception. Yes, come on, tell me. Yes, situation 3 is correct, Kaushiki. That's correct. How about situation 1 and 2? Last 2 minutes. Sorry. Yes, past. Okay, let's solve together in case you have not come up with the answer. Fine. So situation 1, first of all, how will you start with? First, you look at the specified date. First, you want to identify what is my specified date. Okay. So the first thing will be to determine the specified date. My step 1 is identify specified date. For the specified date, what I need to see? Book value of the assets as on date of transfer. Book value of the assets as on the date of transfer. Whose book value you need to see? Whose book value you need to see here? As per explanation 6, you need to see the book value. So the specified date means the date of transfer, the book value of the assets of the foreign company. of foreign company exceed by 15% of the book value of the assets as on last date of accounting period. If the answer to that is yes, then it is date of transfer. If the answer to that is no, then last date of accounting period. Are we clear? Now in the situation 1, you compare the total value, book value of all the assets, not only the Indian assets, but all the assets. So whether in the first case, book value of the assets as on the date of transfer is exceeding the book value of the assets on the last date of the accounting period, yes or no? Just tell me this much. Calculate and tell me this much. Yes. Fast. If the book value of the assets, is it exceeding? This is how much? This is 100 CR. And this is 114 CR. So is it exceeding by 15%? Yes or no? This is 114 CR and this is 100 CR. So 114 CR, is it 15 exceeding by 15%? Yes or no? Fast. At least tell me these answers, the calculations I'm asking you to make. Yes. The answer is no, very clearly, right? So then what date you will take? How is it exceeding, Kaushiki? It is not exceeding, right? It is 114 CR and the book value on the date of the accounting period is the 100 CR. So how is it exceeding? It's not exceeding. Is it clear, Kaushiki? This is 114, this is 100. So this has to be more than 115, right? This is not exceeding. So in situation 1, the answer is no. So then you take the 31st December 2021. Right? Now you have to take the fair market value. The step 2 is the fair market value of the Indian assets should be greater than rupees 10 CR. Right? And at least should represent at least 50% of the total assets of foreign company. Now you take FMV on which date for the situation 1? You take the FMV as on 31st December 2021. Now here FMV is equal to book value, right? So this 60 CR which is there, right? So 60 CR is exceeding 10 CR. I'm talking about situation 1. FMV of Indian assets is equal to the book value. This is 60 CR. Now, is it representing at least 50% of the total assets of the foreign company? What are the total assets of the foreign company? The total assets of the foreign company is 100 CR. So this is representing more than 50%, right? So therefore, even this condition is satisfied. So yes, indirect transfer deemed to accrue or arise in India. Fine. Yes or no? Yes or no? Is it clear? Yes. How 114% is exceeding 15%, Kaushiki? What is your condition? That the book value of the assets on the date of the transfer should exceed 15% of the book value of the book value as on the last day of the accounting period. So 115 is what will exceed the 15%, right? Isn't it? Not 114. So this is clearly not exceeding. You don't need to take 15% of 100. No, 114 is greater than 15, that's correct. But you have to take the differential amount. 114 minus 100 is 14, which is not exceeding the 15% of the 100. That's how you have to take. Okay, Kaushiki? Okay. Next situation, again, whether the book value of the assets as on 25th June exceeds this amount. So this is how much? 116 CR. In this case, this is exceeding the 100 CR. So you will take the date of transfer. In situation 2, you will take situation 2. Yes, it is satisfied. So you will take the date of transfer, which is 25th June 2022. So in situation 2, what is your fair market value of assets? It's a book value only, which is 57 crores. Okay. Now 57 crores, which is there, that is exceeding 10 crores. And whether it represents 50% of the total assets, what are the total assets? 57 and 59 CR. This is coming to 49%. 49%, right? So this test is not getting satisfied. So this is not taxable in India. Fine. Let's go to situation 3. Again, on situation 3, whether the book value of the assets on date of transfer exceed the book value as on 31st December, this is 18 crores. Okay, and this is 15 crores. So is it exceeding the 15%? Yes or no? So yes, it is exceeding, right? So this condition is satisfied. So again, situation 3, yes, and you will take 25th June 2022 as the date of transfer. Now, the value of the Indian asset is 10 crores. Now, this condition itself is not getting satisfied. Sorry, this one. This condition is not satisfied. This condition, whether it exceeds 50% of the total assets, yes, this is satisfied, right? So this is satisfied, but if one of the condition is not satisfied, this is not taxable. It should be exceeding 10 crores and not equal to. Is it clear? Kaushiki, are you clear with this? Yes. The condition is that if the book value of the assets as on the date of transfer exceed the book value of the asset as on the last day of the accounting period by 15%. So the difference between the two should exceed 15% of the book value of the assets as on the accounting period. Clear, Kaushiki? Yes, fine. Okay. Yes. Jacob, it is exceeding in what you're saying, not exceeding in situation 3. What is not exceeding? It is not exceeding 10 CR you are saying, or is it not exceeding you are saying the 15%? What you're trying to say? Okay. Okay. So next question, one more question I want you to solve. This will be solved by you completely. Okay. And then we'll discuss one more point before we conclude the class. ABC Limited is an Indian company, is owned by ABC Inc. Mauritius, which in turn is owned by ABC PLC UK. ABC PLC UK acquired the shares of Mauritius company on 1/1/21 for rupees 10 crores. The Mauritius company acquired the shares of ABC Limited on 1/1/22. Accounting period of Mauritius company ends on 31st December. As on 31st December 22, its book value of assets was rupees 25 crores. On 31st March 2023, ABC PLC transferred the shares of Mauritius company to another company in UK at a price of 50 CR. Book value after reduction of liability and FMV after the reduction of liability as on 31st March 23 is as under. Mauritius company ABC Inc. book value is 30, FMV is 50, liability is 0. ABC Limited Indian company book value is 110, FMV is 180 and liability is 20. You are required to tell me whether indirect transfer provisions are attracted in the first place. Yes. Jacob, how it is not exceeding in the first case by 15%? This is how much? See, this is 18 CR and this is 15 CR. Now 15 CR and 18 CR, the difference is 3 crores, right? And the 18 CR, 15 CR, 15% goes to how much? 15 CR into 15% is 2.25. So this is, the difference is 3 CR, right? Which is exceeding 2.25. So it's exceeding Jacob, right? In situation 3, it is exceeding. Here you can just make one small change so as to make it interesting. The Mauritius company acquired the 20% shares of ABC Limited. You can make your change 20%. Okay, Jacob. Yes, fast. Tell me the answer. Whether we have to take the book value as on the date of transfer or, sorry, whether the book value is exceeding as on the date of transfer by 15%, not exceeding 15% or exceeding 15%. Yes. Which date you have to take? Date of transfer or date of the accounting period end? Yes, Kaushiki, that's correct. We have to take the date of transfer. So here, if you see very clearly, the book value of the asset of the Mauritius company, this is 30, as on the date of transfer. As on the accounting period end, the book value was 25 crores. So the difference is 5 crores, right? Now, 25 crores, if you take the 15% of that, 25 crores, if you take the 15% of that, how much it comes? It comes to 3.75. And this is exceeding that. So we have to take, so the first test is whether book value as on date of transfer is greater than 15% of book value on accounting period end. The answer is yes. So therefore, we have to take the FMV as on date of transfer. Now the second test is FMV as on date of transfer. Right? What is the FMV as on the date of transfer of the Indian assets? We have to now look into the Indian assets. This has to be without considering liabilities. This has to be without considering the liabilities. What is the FMV? 200. But we don't need to take the entire 200 crores. Why? Because if you see, I made a small correction over here. Mauritius company acquired the 20% shares of ABC, not entire 100%. So 200 crore into 20%, which is only 40 crores, is the stake of the Mauritius company. The other 80% may be held by any party. We are not looking at it. We are just talking about the sale which has happened of the Mauritius company's share. So we are only concerned with the 20% stake, which is of Mauritius company. Because that is getting sold, right? The Mauritius company's shares are sold and Mauritius company is just holding 20%. So FMV you have to take proportionately, which is 40 crores. Right? Now the total FMV, this exceeds rupees 10 crore? Yes. Whether it represents at least 50% of total assets, value of total assets, again you have to take FMV. So what is the value of total assets? What is the value of total assets? What are the total assets of the Mauritius company? What is the value? Fast. What is the value of the Mauritius company that you will take? Very quickly. I'm waiting for your answers. Yes, this is simple. What is the value you will take for the Mauritius company's FMV? Nobody knows the answer? How 110, Jacob? No, it is not 110. You are taking the book value here 110, which is that too also of ABC Limited. What is the value? 50. Yes, Kaushiki, the value of the Mauritius company is 50. So this is representing 40 divided by 50. This is representing greater than 50% of the total assets. So even this condition is satisfied. The value of the FMV of the Mauritius company is 50, not 110, Jacob, right? Is it clear? So both these conditions are satisfied. So therefore, indirect transfer taxable, deemed to accrue or arise in India. It is, you don't have to write here taxable, but you have to write it is deemed to accrue or arise in India. Now let's say the second part of the question says compute the capital gain. How will we compute the capital gain? Full value of consideration. At what price it is being sold? This is being sold for 50 crores, right? So this is my sale consideration of full value of consideration, 50 crores, less the cost of acquisition. What is my cost of acquisition? Tell me the cost of acquisition. Yes, what is the cost of acquisition? We have to compute the, yes, Kaushiki. The cost of acquisition is 10 CR. Very clear. Do we provide the indexation here? Is it a long-term or short-term capital gain? What is the period of holding? What is the period of holding? It is short term, less than 1 year, because this was purchased in 2021 and this is sold in 2023. So how is it a short term? This is purchased on 1/1/2021. What we are looking here, the shares are sold of the Mauritius company. The capital asset which is transferred is the shares of the Mauritius company which was purchased in 2021. It is sold on 31st March 2023. This is sold on 31st March 2023. What is the period of holding? The period of holding of the, no Jacob, it's not 36 months. For unlisted shares, the period of holding is 24 months. The period of holding is 24 months. What we have transferred here is not the shares of Indian company. We have transferred the shares of Mauritius company. That is the capital asset which is transferred. Now, those shares of the Mauritius company are deemed to be situated in India, and therefore, the income from the transfer of the asset is deemed to accrue or arise in India. So, shares of Mauritius company are deemed to be situated in India, isn't it? Now, this is the share of, this is the unlisted company share. For unlisted company share, the period of holding is 24 months and not 36 months, Jacob. So here, since the period of holding is greater than 24 months, this is a long-term capital gain. But tell me whether indexation will be provided here or not. I'm coming to that point, Kaushiki. Wait for it for a minute. Answer me about the indexation. Also, let me just put a small twist over here. This ABC Limited is a listed company. So whether you will apply 112 or 112A, we will not provide for indexation. We will not provide for the indexation. Why? So whether 112 or 112A is applicable, if it is a long-term capital gain, whether 112 or 112A will be applicable. One one two Kaushiki, yes. So here the transfer is of the shares of Mauritius company and not Indian company. So it will be under 112 even if the underlying company is a listed company. Now under 112, in case of a non-resident or a foreign company which is transferring these shares, which is unlisted shares or securities, then the tax rate will be 10% without giving effect to the first and second proviso to section 48. So here 40 crores is my long-term capital gain, but again here I will do the proportionate. So section 915, section 911, the explanation to that provides it very clearly. So the explanation what we spoke here now, it very clearly provides that while computing this income from the indirect transfer, while computing the indirect transfer income, in this particular case, only the proportionate amount will be taxable in India. Only the proportionate amount will be taxable in India and not the entire amount. Is it clear? So only the proportionate amount is deemed to be taxable in India and not the entire amount is taxable in India. Okay. So in case there is indirect transfer provision which is applicable, the entire amount here is not taxable. The amount which is taxable here is the proportionate amount. So no income shall be deemed to accrue or arise in India unless it is attributable to the assets in India. Are we clear? The manner of the determination of the amount is given under Rule 11UC. Rule 11UC, which is there, provides for determining the amount or for attributing. And how it provides is, let me tell you. So the long-term capital gain is not entirely 40 crores. Rule 11UC provides that the income from transfer outside India of a share which is attributable to assets located in India will be determined as A into B divided by C. What is A? A is my capital gain. Into B is the fair market value of the Indian assets as on specified date. As on the specified date. So fair market value of the assets located in India as on the specified date. And the C is fair market value of all the assets of foreign company as on specified date. So in this case, you will do 40 crores into what is the fair market value of the Indian assets as on the specified date? This is 40. We are taking the proportionate amount only and not entire 200 crores. Because out of 200 crores, only 20% is held by the Mauritius company. What is the fair market value of the assets as of the foreign company as on the specified date? 50 crores. Right? So this will give you 32. Your 32 crores is the long-term capital gain and not 40 crores. Are we clear? Or let me write it in the next line. This is 32 crores, my long-term capital gain. On this, tax at the rate of 10% under section 112, 3.2 crores. And you will not give no benefit of indexation as well as first proviso to section 48, which is the exchange rate fluctuation. Fine. Yes or no, clear? Is indirect transfer provision very clear? Yes. Will you revise again tonight? Because this is more important than poem. And now you are supposed to revise poem as well as indirect transfer both. Is it fine? Done? Yes or no? Okay. So I'm giving you a task. You have to revise both these provisions, poem as well as indirect transfer, before we move to the next class. Yes, Kaushiki, this is a little complicated, but when you will revise, it will get registered with you. Okay? In case you are stuck up anywhere, do reach out to me in the next class. We will again just have a recap. But do revise the questions. Okay. Thank you so much. See you in the next class on Wednesday. Wednesday, yes. Okay. Thank you so much.